Hi, I'm Malessa.
And I'm Candice.
Welcome back to The Build Up, presented by Brown Harris Stevens, where we discuss the secrets of building wealth through real estate.
Today we are joined by Brown Harris Stevens chief economist Greg Heym, who is going to be sharing his expert insights on the intersection of economics and real estate investing. We're also going to be diving into a pressing issue making the headlines on the impact of Wall Street on real estate.
Like you mentioned, we've seen this headline in a lot of different articles and also on social media everywhere. But the most recent one was Forbes, right? That article that we read together, actually. And it laid out some pretty concerning points about the monopoly Wall Street has on the housing market.
Yes, they have a huge purchasing power, so they've actually been going in all different markets, but primarily buying single-family homes and converting them into rentals. So it's really limited the inventory in many markets, which we have already been discussing. We have a housing shortage and housing inventory shortage nationwide, so this is really putting more pressure on that. A really surprising stat was that 1 in 3 homes in Texas were actually purchased by a PE firm last year, so a third of all of the homes. Meanwhile, Wall Street owns 1.2 million homes across the country.
But this doesn't affect the big markets like LA, New York City, and San Francisco, but more so the submarkets in the 300 to 450K.
Yeah, and this obviously is really hard because middle-class Americans are already struggling to purchase homes as it is, with affordability, with interest rates, with lack of supply. And then now you have these really large institutions coming in with unlimited purchasing power, it seems, to really take up a lot of that remaining inventory.
And there's also the concern that these institutions are sort of hoarding these homes and they're not releasing it to the market. So they're outbuying these middle-class Americans and owning homes.
Yeah, and because of this, right, whenever you have a decrease in supply and an increase in demand, pricing is going up, but not by just a little bit. In some markets, it's going up by 30 to 40% because of the hoarding and the monopoly that we're discussing here. So it's putting families and many people in general into a perpetual renting cycle because they just can't seem to catch a break, basically, and really enter the housing market as an owner.
And then there's also the impact on the local economies and also on how the homes are being maintained.
Right. As we know, investors never keep the quality of a home up to the same standard that an end user would. And so we're not seeing the same investment into these properties. They're not being upgraded and the conditions aren't being maintained as well as they would have if they were owned by an end user. And so that's actually trickling down into the economies themselves beyond the housing market. It's having a long-term impact beyond just, okay, this home is not in like perfect condition. It's that now the local economies are not benefiting from that infusion of, capital improvements and cash that an owner would otherwise do, more like an end user rather. And so, it does have a big impact beyond just everything we've already been discussing. It also impacts the communities because, again, they're not being invested in the same way that someone would who's, it's their home and they want to like really invest in it. These are just investors who don't really have as much pride into what they're, purchasing.
Right. But this is very concerning. So that article talked about some proposed solutions, and that includes some regulations and taxes.
Right. So taxes is actually really interesting because it can be used in 2 different ways. On one end, you can increase taxes to, discourage institutional investment, right? Anytime you're increasing taxes, that's minimizing returns, and it's going to discourage them, hopefully, and curb their appetite a little bit. But on the other hand, you can also give them a tax break incentive to release some of this inventory that they've been holding on to, which would then put it back out in the market for end users. So taxes can be used in both ways. But, this issue has really been bubbling up over the past 3 to 4 years or so. So, of course, regulation is always the last thing to come in. So there really hasn't been much regulation about how these institutions are going about and acquiring so much property. But, of course, now that it's become a real issue, that's when, the local, governments are now stepping in to try to figure out something to, make this more balanced.
Yeah, there needs to be a change because, like we said, this is very concerning, but it's a very complex topic. But also the proposed solution seems to be very sensible. So we're going to be keeping a close eye because, again, these are, Americans who are being priced out of being homeowners, and that's not okay.
Yeah, home ownership is the cornerstone of financial stability. And so they're now being taken away that opportunity. So I definitely want to see how this can sort itself out a bit.
Exactly.
Today we welcome Brown Harris Stevens, chief economist, who has been widely recognized as an industry expert and frequently quoted in the New York Times, Wall Street Journal, CNBC, Bloomberg, and more. Having a knowledge of economics can give real estate investors a helpful advantage, which is why we couldn't be more excited for today's guest. Greg, welcome to The Build Up.
Well, thank you, Candice and Malessa. I couldn't be more excited than to be here. And thanks for the cup. It's great. You have nicer mugs than me, so I have mug envy. I'll get over that. But it's great to be here. Thanks so much.
Thanks for being here and having this conversation with us. And, I think the big question everyone asks us, and we know that, and of course you know this, how is the market, right? But it's such a broad topic, and we're going to do our best to break that down. But before we go there, can you give us a summary of the economy and the housing market in 23?
Well, we're all looking for the soft landing with the economy. Think of it like landing a shuttle on the moon, right? You don't want to go too fast. You just want to ease, get inflation down without causing a recession. Now, that's something the Fed historically has not had a lot of success with. They let inflation get too hot. They had to act swiftly and painfully. We saw the damage that's done, particularly on housing. But it looks like they're probably going to get there. One of the things that's frustrating is you hike rates at a pace you haven't seen in decades. Consumers continue to spend. Unfortunately, they've run up a lot of credit card debt, over $1.1 trillion at record rates. The excess savings, the money you couldn't spend during COVID that the government was sending everybody, that's gone. But we just found out this morning retail sales actually rose last month. It's not as good as it sounds, but it's better than if it declined. But, we're looking at those inflation numbers the Fed watches, and they watch, I joke on my show that the consumer price index gets all the love. But actually the Fed looks at something called the personal consumption expenditures price index, because that tracks what people actually spend. If you go to a store and steak is too expensive, you might pick chicken or something else. So the CPI doesn't account for that, but PCE expenditures do, because they look at what Greg and you ladies actually buy. So they look at the core value of that. That is basically stripping out food and energy prices because they're very volatile. Energy prices had been coming down until last month. Gas rose sharply in February. But that said, hiring is unbelievable. We added 275,000 jobs in February. And the funny part is there's still 8.9 million available jobs out there. It's hard to imagine, but, there's still this labor shortage going on, even with all the layoff announcements that we hear. I guess the key thing with the economy is, depending on what you're looking at, you could be either very pessimistic or optimistic. If you're looking at all the layoff announcements and all the talk about that, the Wall Street Journal had a whole long list of them a couple of weeks ago. But then you look at the data and claims for unemployment are down. There's all these jobs out there. Hiring is brisk. So things seem pretty good. I think we're getting to an area where we've got inflation down under 4% year over year. That's huge because it was running 9%, almost 2 years ago. So, but that last 2% to get it to the 2%, that could be the hardest part. I liken it to being in the red zone in football. It's the hardest place to score sometimes because the defense tightens up. So that's been good. It was really good for us at the end of the year when mortgage rates went down by over 1%. Rates hit a 23-year high in the middle of October, and then this big decline. And we're like, all right, this is good. We have momentum coming into 24. Started off great. If you look at existing home sales, they were very good in January nationally. New home sales as well. But then rates started to go back up. And that is, it's not as important here as other parts because, it's a lot of all cash deals and the price points are much higher. But, the stock market has seemed to shrug this off. That's another thing that I think we forget about. Coming off a great year, we keep seeing weekly records, whether it's the NASDAQ or the S&P or the Dow. So there is optimism there. But we need rates, to go down. That's the thing that we need to get the housing market going. We just found out that rates fell for the second straight week to the lowest level since early February. So, and rates right now are only a little bit, 10 basis points higher than they were a year ago. So things have turned around, and that's good, even with the hotter than expected inflation data we got this week. Hopefully that momentum will continue. I think the good thing about the market here in New York City is there is inventory. So many other parts of the country, there's no inventory.
Yeah.
And prices are still rising, even as rates have remained very high because your choices are that limited.
Yeah, we were just talking about that.
Yeah, it's look, it was good to have healthy inventory when COVID hit because when it came out, we got very busy, but prices didn't get too high because there was still enough inventory. And then when rates, basically doubled before our eyes, in the blink of an eye it seemed, we didn't see big price declines because they hadn't risen that much. So we haven't had this price roller coaster. But I think the other thing to remember is everybody's saying, when's the Fed going to cut rates? And to me, it shouldn't be, I would say the fourth quarter because the economy doesn't need rate cuts. It's doing just fine. But if it's June, it's not going to be this month. The markets tried to bully the Fed into doing it in March, but they said, no, we're not going to do it. So a lot of people think in June. But just remember this, we don't need the Fed to cut overnight rates to get long-term mortgage rates down. That's all about getting inflation lower. And I think that's what we need to be looking for instead of, what Jerome Powell and the Fed are saying and what they might do. Because there's no direct correlation between the federal funds rate, that's the rate that they're changing when they have these meetings, and the 10-year Treasury, let's say, which is the driving force for mortgage rates.
We want to go back a little bit to what you're talking about, how in 2023, the prevailing sentiment was all about recession and heading towards a recession. But as we discussed, that didn't seem to happen. The market didn't seem to crash like many thought that it would.
And I looked like such a fool. I mean, it made a lot of sense at the time that consumers were going to cry uncle at some point.
It did.
And I guess we underestimated the resiliency and how much credit they had.
Yeah, that's what we wanted for you to break down a little bit, which is why exactly did both the general market and then the housing market not crash like many thought it would?
Well, I think the better than expected performance of the economy is a good thing and a bad thing, right? We thought for sure, economists like myself thought by the end of last year we'd be in recession because how much longer the inflation had dragged on for 2 miserable years almost, where it was just crushing people. Prices were growing much faster than wages. Even with a hot job market, the wages can't keep up with nobody's getting 9% raises like prices were rising. So I think the excess savings, again, that's the money that a lot of people got. The government sent a lot of money out during COVID, but even if you were working, it was very hard to spend. So literally billions of dollars got saved, and the savings rate went over 30% in this country. Pretty amazing. The question was how much of that was left. It's really hard to know. There was some Fed banks that tried to estimate it. Jamie Dimon says he thinks it's almost all gone. A lot of people think it is all gone. So I think it's demand's always hard to measure. That if rates get low, the demand for housing is going to go up because it's all of a sudden very affordable. But when it comes to consumers and how much they can spend, they're 2/3 of the GDP number, 2/3 to 70% of that number is consumer spending. And GDP was up much more than expected in the fourth quarter and will probably be positive in the first quarter. So that leads to the housing market. 2023 was not a great year when you compare it to 22.
Nope.
For most markets, they could say, well, we have no inventory. What were we supposed to sell? It's not so true here. And it's, the volume was down about 35% year over year, and that's pretty consistent across the different boroughs. Prices didn't go down, though, so that's good. And, we've had the high end is shown amazing numbers. And especially in townhouses. We've seen some amazing sales and some resales and recently built condos. So, the wealth is still coming to New York, and the forecast for the dollar is a strengthening dollar, which isn't the best thing to attract foreign investment, but it does show stability in our economy. And we have outperformed most other countries.
Right. One thing I thought was so fascinating was that 70% of all the deals that got done in New York City in Q4 of last year was all cash. The amount of cash that's in the market, at least here in New York, is really incredible. And I was really blown away by that stat.
There's a lot of money.
Yeah.
I mean, just think about Wall Street bonuses, right? In a decent year, they could be $25 billion or more. I mean, think about that. That's
one industry.
That's like a quarter of the city's budget. It's an amazing amount, and that's in cash. We'll be getting those numbers in the coming weeks. Typically, they come out the end of March or early April. But when Wall Street has a great year, the money's there.
Yep.
It's just people are trying to find the right time and the right opportunity.
And that's what we saw in 21 as well, right?
Well, that was the FOMO market, right?
Yeah.
Because even though we weren't running out of, we look at inventory in terms of months supply. How many months would it take to sell what we have, if nothing else, enter the market? Because if I tell you there's 10,000 apartments for sale, your next question might be, well, is that a lot? Sounds like a lot. But if you're selling 5,000 a month, that's a 2-month supply. And across the country, there were month supply numbers under 1. I mean, you almost measure the days on the market in like hours on the market. It got to be that overheated. And unfortunately, that's not going to change.
Yeah.
And you look at some of the luxury markets that we're in, Connecticut, Palm Beach, obviously, Florida's been on fire, New Jersey, suburbs, Westchester. I live in Nassau County. I can't believe what some people think my home is worth, but I'm happy about that.
Yeah.
But it's part of the economy that we do have here, and New York City's recovery has lagged. There's no question. We don't have the percentage of people back in their offices that we'd like to see, but I think that means we still have legs left in this recovery, and I think Wall Street certainly helps getting more people to come back and to go out to lunch. And I know restaurants are mobbed at dinner time. Lunchtime, they could use a little more.
Yeah. You mentioned that the recession was one thing that, you predicted. Of course, it didn't happen. It's hard to be a forecaster. We were talking about that before, because it's, you're.
Well, you say recession because then if it doesn't happen, they'll be happy. Like, you were wrong.
That's true.
I'll be like, thank you.
Yeah, that's true. But now that you've had a chance to kind of look back at 2023, what things were you right about, and what were other lessons that you learned from that past year?
Well, I was right, and it was easy to guess that inflation was going to come down with that kind of aggressive rate hiking and some of the other operations that they changed. They just don't touch this rate. They go out and buy or sell securities that they own, depending on if they want to inject money into the system or out of it. So I think that was sort of easy. I knew the labor market would remain pretty strong in terms of hiring, because at one point there was well over 10 million jobs available.
Wow.
And that was holding economic growth back, right? Because you can't be open as long, and you need to find the workers. But unfortunately, the labor force participation rate, which is the percentage of working age people that are looking or are actually working, that hasn't gotten back to pre-pandemic levels yet. Could be for a variety of reasons. The thing that I underestimated was the strength of the baby boomers. So much of the spending in the second half of last year and even into this year is baby boomers. They have the money. A lot of them, there's an article in the Journal about this. They were very happy to get out after COVID. They wanted to go places. They wanted to do things. So they're helping carry the spending, which is fine. That's great.
Yeah, there was another stat that was, and I don't have it exact, but it was something about how right now, like the average age of a buyer, of a homeowner, is like between 40 and 50 years old, which is, it speaks to very much of like the affordability crisis that we talk about, and all these other factors that the younger generation has had to go through with trying to enter the workforce, like during or after COVID. So yeah, it's really interesting how much the age has increased of homeowners, whereas it should be hopefully younger.
Well, there's a lot of disillusionment among younger generations. There was an article, I forget who did the survey, but, half of home buyers, that feel they'll never be able to afford a down payment.
Yeah.
And it was interesting because one of the things they said is it would take at least 5 years. And I'm like, I saved for 8 years before my house. I think there's also there's a lot of misconceptions about housing and other markets. But I think this idea that you should be able to buy a home right away is something that you got to think about because it's always been expensive to buy a home. It's never been, in the old days, maybe you borrowed money from family. You only needed a couple $1,000s. Now you might need $100,000 to buy, an average home in a neighborhood. And I think also this goes back to the financial crisis where people started to change their opinion of housing and the mix of their investments. They knew they were going to have to live somewhere, but I think the counting on constant appreciation or this endless amount of equity to withdrawal, things changed after that.
Mm-hmm.
Yeah, definitely agree. But you have to have a strategy, right? We touched on that on our previous podcast topic as well. But just, going back to something you mentioned earlier about a soft landing, do you think just based on the overall market of last year that we did indeed have a soft landing, or should we be bracing for turbulence ahead?
Well, in terms of the economy, we haven't hit that landing yet. The economy is still pretty hot. Housing, we need two things to happen. It's very similar to inflation, right? Inflation is caused by one of two things or both. Not enough supply, too much demand, or a little of both. COVID, we got a lot of both, and you see what happens to prices. So I think that with housing, you need more inventory. Not here. You always need more quality inventory. But in markets like Connecticut, where they could rattle off the top of their head, their homes for sale, because you mentioned affordability, that is a concern because prices still going up. Rates, have gone down the last couple of weeks, but not to the level we would like to see. We were hoping that rates might dip below 6 by the end of this year. I don't think that that's going to happen. It's possible. But another thing to remember, too, is the average 30-year conforming mortgage rate over the last half century is 7.8%. So it's another misnomer. People think, actually, there was a survey done, and they said, what rate would it take to get you to buy a home? People said 5.5%. They said, why? And they said, well, that's what they typically are. But you're wrong. And 3% mortgage rates had never happened before. And there's no guarantee they're going to happen again. Can't say they will, they won't. So I think the economy looks like it's headed more towards a soft landing than housing. I think that we need to get more inventory because it's hard to know pricing when you don't have enough sales too. And there's this rush and multiple bids. And by the way, I hear that from brokers here. Well-priced properties are going to draw attention and sell quickly.
Yeah.
Of course.
Would you agree that the sweet spot for mortgage interest rates is between 7 to 8%? We have kind of heard that seems to be where the market kind of balances best, but would you agree with that?
No, I don't know that there's a specific rate that, we always want them lower. There's plenty of balance. I think that people understand by now that forget about expecting rates that starts with 3, 4s, 5s. Those days have left for now. I think people have to make decisions, and you see what pent-up demand looks like. Think about, what happened after the COVID reopening. We were a little bit late to the party, but 21 into the first half of 22 was like the best year and a half ever. Even after Lehman Brothers, once stock market bottomed and started going again, it was gangbusters. So I think, it's people, it seems that buyers and sellers are it takes a while for them to get on the same page.
It does, yeah.
And I think a lot of buyers may be looking for price discounts because of the higher rates, but inventory is the one true indicator you have of a market's value and where it's headed. It's the most honest thing out there. Demand is hard to measure. People want it. There's money, And also another thing is people should always talk to their lender. The rate you see posted in whatever journal you read or website you go to, the Freddie Mac rate or whatever it is, that's not always the rate you're paying. If you have a relationship with a bank, you can get a very good deal. Another thing to remember, and I'll credit this to my buddy Stephen Lasher, who points it out all the time. When rates were 3, 3.5%, you were getting 0.25% on your savings. You know, that was a very, low, a very wide range of what you were borrowing at, even at 3% when you're getting less than 1% on your money. Now you can get mortgages for 6 and change and get 5%, in a money market account.
You can also buy down your rate, which is something that a lot of buyers are not aware of, and bring down that monthly payment to something more affordable. So, and you can work with when you're negotiating on the property, you can ask for a credit and the amount it would cost to buy down your rate. So you're actually getting the right payment. And you're not coming out of pocket for that cost to buy it down. So that's a tool we've been trying to educate buyers on in this market, how to be creative.
So much that, even a humble economist doesn't know about mortgages until you go through it.
Yeah.
I think that's where professionals like brokers and mortgage lenders can really educate you. And you should find out and get qualified and be ready to move, because quality product at quality prices sells fast in any market.
It's true.
Exactly.
Let's talk about politics, everyone's favorite topic.
All right.
Who are you voting for and why? No, I'm kidding. So it's an election year, and that adds another set of complications to any market. So before we get into what you think may happen this year due to the election, what typically happens? Like in the past, like what historically happens?
See, I don't buy that there's this implied impact or an election has on housing, because they don't happen by themselves. Let's go back. Think of the last, presidential election was during COVID. That was a big thing, and people were angry, and that I think that might have had as much influence on the election as anything else. You can think about when Obama got elected in the wake of the financial crisis, or Bush being elected after the tech bubble burst, or Clinton after a disastrous recession. Nobody thought he was going to beat Bush. After the first Gulf War, it looked like Bush had a cakewalk, and then he made some bad decisions, and there was a recession, and he didn't seem to address that. And Bill Clinton capitalized on it. So I don't know. I mean, the data you see will show that at least with stock markets, they tend to do better under Democratic administrations. I don't know if you can really isolate that stuff, and I don't know that it matters. I think for home buying, it's finding the house you want or the apartment you want or whatever you want to rent, and making the decision that's right for you at that time, or a long-term decision. In this election, both the people that look like the nominees have already been president. So I think we kind of know what to expect. I think when you have somebody like Donald Trump, who was not a politician, get elected president, people are like, whoa, what's going to happen? And, the world didn't end. So
that's a really good point, which is like if these two become the nominees, we more or less know how they'll behave and what the market will behave like. Maybe we'll see.
Well, I got to remember too, we have a divided government right now, and it's when one party's controlling all three that I think people could be a little more concerned, because one of the things that's going to come up is the SALT cap.
Yes.
Which, again, the Democrats could have repealed. They controlled the House, the Senate, and the White House, but people here in New York or Connecticut, New Jersey, and California forget that the rest of the country is perfectly happy with tax reform. The average taxpayer is paying less in taxes and not having to, getting a nice standard deduction. So, tax reform expires in 25. So we'll see what happens. I guess it will depend on who's in charge then. But at the end of the day, I don't know. You tell me, have you ever had someone back out of a deal because of the outcome of an election?
No.
No, I mean, maybe they want to wait till after it, but they're still going to make the same decision. I think. Again, these things don't happen in a vacuum. We're at a point right now where we're trying to slow the economy down, get inflation lower. Stock market seems a little too happy. And we're just hoping that we don't push it too hard to go into a recession. And I think that's what people are focused on, mortgage rates.
Nationally, though, where do you see pricing heading, both for sales and for rentals? Do you see them holding firm, softening?
Well, the sales, it's all about inventory. And most markets will probably not go up much more. I think they'll hold steady. Rents have already started to level off a bit in most parts of the country. And, the problem, too, is we're not building. We talk about this here in New York all the time. We're not building, but it's a national problem. And if you think about, the most places outside of New York, the majority of the owned homes are single family homes.
Right.
But remember, over the last couple of years, hedge funds have been buying those up by the hundreds of thousands. They've even created their own towns. Like something in Oppenheimer where they build a town with.
Yeah.
So, we need more housing construction. Remember, when rates go up for home buyers, they go up for lenders. I mean, for builders too. Now, builders are a little more optimistic than they've been in a while. So hopefully we can continue to get more. That's the easiest way to make housing more affordable that we can control, and that's to build more.
Exactly. And there are a lot of variables here, right, that we've been discussing. And I think one of the big questions we always get from our buyers, especially our first-time home buyers, and as part of that education, right, is now a good time to buy?
Right.
How would you answer that? I'm just going to play this clip for our buyers going forward.
Yeah.
What camera you want me to
Yes.
I think, Susie Orman has this thing where if you want to go on vacation or buy something, she determines if you can afford it and gives you the stamp of approval. Now, I wouldn't say to call Susie Orman, but if it's what works for you, if it's a place you're going to live in long term, and I'm a perfect example. I bought my house in Long Island in 2006. Couldn't have picked the higher high of the market, right? Mm-hmm. Except now, and it's come back in a big way. But even when it was worth less than what I paid, I'm raising my son there. I love where I live. I live close to the beach. That my commute to the city is not so bad. I love my neighbors, and I think when you have that positive of an experience of finding exactly what works for you, and you're very happy, you're not going to think about what you paid for it. Whereas a stock, it might be, what did I get Bitcoin at, right? Mm-hmm. Or Nvidia, what did I think you're always thinking of that. Mm-hmm. But I think if you're happy with your purchase, because the old expression is, when there's a sale on Wall Street, nobody wants to buy, right? Mm-hmm. Housing's the same thing. Mm-hmm. When it's going down in price, nobody wants to buy because there's no fear of missing out. Mm-hmm. And then people are forced to make a decision, like now with scarce inventory. Mm-hmm. I think, you have to realize too, the old expression, you marry the home, you date the rate. Exactly. So there's never a one-size-fits-all financial advice for everybody. Some people shouldn't buy. Some people, if your job may, relocate you, or you're planning on moving for some reason, or expanding your family, or shrinking, renting might be the best alternative. So mm-hmm. I get that asked all the time. Where's the best place to buy? Mm-hmm. That's an easy answer. If you're looking just to get the best deal, you buy where nobody's buying, because that's where inventory is high. Mm-hmm. Here we've seen anything that needs renovation, is having a hard time, mm-hmm. particularly older co-ops. And that's the value play right now. Because there is a lot of, recently built condos out there with a lot of amenities. But these things go back and forth. It's not that one group of properties always is going to outperform another.
Yeah. And people also forget that real estate is a long-term investment. So, like you said, you can't just be looking at this market of 24 or, next year. And so based on that, do you feel that we are currently in, or do you think we're approaching a new economic cycle? Like, where do you think the next 2 to 3 years plays out?
Well, I think this is sort of the end of the cycle, the sort of the COVID, the shortest recession in U.S. history, and the most the most rapid recovery ever. And I think that it may not be this year, but next year it'll be a sort of a new normal. The question is, what happens when we hit that soft landing from that point on? Can we find another gear? We forget that we had almost unprecedented economic growth before COVID. Mm-hmm. That was an unbelievable. And that hurt our market, because you remember 2018 and 2019 were very slow housing markets, because without a recession, prices don't reset. Not that we want recessions, but people are like, well, wait, the stock market's at a record. I'm not cutting the asking price of my apartment or townhouse. So I think a new cycle, probably next year, we'll see what if we expect to see economic growth and hiring continue to slow. But it's slowing at such a slow pace. It's almost frustrating, and you feel like you're rooting against your own team. It's like, come on, don't come in higher than expected. Don't come in. We always have a joke on my show. Anything that comes in higher than expected is not good news in this market.
It's counterintuitive, but that's why we have you here to explain that to us so that we don't get excited. You mentioned that good places to potentially invest, not so much like where would you buy for your primary, because that brings in many different factors, but talking more about just investment in the real estate market. You mentioned the best place to look are places with high inventory. Are there markets nationally that present more opportunities to invest?
Yeah, I mean, there's always cases. There are some more speculative markets. Everybody thinks Manhattan is this big specular market controlled by, investors trying to make a buck. And, that's not easy to do right now based on the conditions here. But you wonder areas like Miami, Las Vegas that are very boom bust, if that may be an opportunity down the road. But it's hard to think of other major cities because the inventory levels are so low. And look, a lot of these areas are having budget squeezes. There's a lot of costs. The migrant situation, you see what it's done to New York City's budget. Texas has to deal with it, Florida. I think for people, if you really want to take a big risk, look at commercial real estate. I mean, that's a good point. It's certainly out there. You got to think outside the box sometimes. And I started at the real estate board in New York in 1995, and all I've heard for the almost 30 years since is commercial real estate is dead in Manhattan. Whether it was 9/11, the financial crisis, all you hear about is that people don't need to come into an office. No tech firms are going to want to be here. Meanwhile, Google can't buy up enough buildings. Amazon, even after the deal in Long Island City went south, they have a presence here. And the funny thing is they're telling their employees to come back. So, I think you have to approach every deal uniquely and look at your time frame. Because it's like a developer. Some developers can hold on to a site and wait it out, and some can't. They wind up selling the site. So I think the one thing is, remember, the costs have become so much more expensive, whether it's commercial or residential, land costs, construction costs, labor costs. It's all still so pricey. And hopefully that'll change. But change happens slowly, particularly when it comes to real estate, unless you have a pandemic and you can't show houses, or two banks that survived the Great Depression crash, like we saw with Bear Stearns and Lehman Brothers. It takes something like that. But, you can go back to the 70s, at least. I'll only go back as far as my life. The 70s, New York City was going broke, right? They had to bail out the city. 80s, and 90s, there were drug and crime problems. You had 9/11. You had the tech bubble burst. You had a financial crisis. You had Sandy. Who's going to live downtown? It's going to all be underwater. And then you had COVID. No one's going to want to live in dense cities again. All wrong. I always make a joke. Never bet against New York City. Just bet against its sports teams. Except the Yankees, they don't win very often.
Oh, that's a good one.
Well, that's what we're going to quote you on.
Yes.
Well, that is so helpful. Thank you so much, Greg, for being with us today. You've given so much advice and helpful knowledge for not only our listeners, but us too. We're learning, just listening to you.
Well, I have to be friendly, and the audience should know that we are next door neighbors.
We are our neighbors.
Yes. And we're also 3 feet from the studio. So I always say that's what I love about the studio is a couple of steps and I'm in there.
Exactly.
But we have this good neighbor thing, and thanks for the mug.
And
I will have you on my show.
Yes.
I know you're very in demand, so I'll have to talk to your agent.
Yeah, please.
I got to get an agent first, and then I'll have him or her talk to your agent.
Well, thank you so much.
Do you know anybody that can act as my agent?
we'll get you a name.
Thank you, Greg. This has been so fun.
My pleasure.
Thank you so much, Greg, for joining us today. We learned so much from listening to you and hearing all of your forecasting for the next year.
Absolutely. We're always so happy to chat with Greg.
Today's episode is presented by Brown Harris Stevens. And as always, you can find us at tower.com and by following our social media at Tower.
See you next time.